Welcome to the Just Word Podcast. I'm Pat Bolland. The Just Word Podcast is brought to you by Just Wealth, investing the way it should be, just for you. Chances are, if you've been saving for your retirement, you know what a RRSP is, or even an RESP. There's a lot of acronyms out there. I'm going to throw a new one at you, the PPP. JP Laporte is a pension solutions consultant, CEO of INTEGRIS Pension Management, and he joins me right after this break. JP, a real pleasure to meet you.
Nice to be here.
Okay. Some people, I hope a lot of people now, have heard about what a PPP is. What is it?
Well, it's a personal pension plan. That's what it stands for. And a personal pension plan is a type of registered pension plan.
Oh.
So registered pension plans have been around for a long, long time. They find their roots in the very first Income Tax Act of 1917, the one that we used to finance the First World War. So this is very old legislation, but PPPs have only been around for about 10 years. And they're similar to another product, another acronym, the IPP, or Individual Pension Plan, except that the PPP is significantly better and more powerful than an IPP for a bunch of reasons.
Okay. Well, then let's start at a kind of more basic level. People kind of know what an RRSP, Registered Retirement Savings Plan, is. How is a PPP different from that?
Well, a Registered Retirement Savings Plan, or RRSP, comes with one annual tax deduction, your annual contribution. A PPP comes with 8 deductions, and some of these deductions dwarf the RRSP annual contribution. So it's not even a fair game, a fair fight between the two in terms of how much money a business owner can put aside towards retirement if they use a PPP instead of the RRSP. And I'm happy to walk you through all 8 of these deductions.
Yeah, let's do that, because
Sure.
it sounds interesting.
Yeah, I would think so. Well, the big picture is that over a lifetime, it's very easy to triple, if not quadruple, the amount of tax deductions that you can claim with an RRSP. You can triple or quadruple them if you use a PPP. So that's why I said it's not really a fair fight between the two solutions in terms of which one will get you to retirement sooner. But that's the law. That's how the law works in Canada. And those who know the law and use it get all these advantages that I'm going to be talking about. Everyone else, which is about 98% of the population, are in the dark. They have no clue, and they're stuck with the RSP with its single deduction.
Oh, okay. So what are the 8 deductions?
Sure. So number 1 is what we call the purchase of past service. So this is where you're a business owner, the company has been paying you a salary or a bonus or both for a number of years since you started. Maybe not, maybe only a few years because you took dividends here and there. And when we start the plan, we say, you know what, we didn't have a plan back then, but that's okay. We're going to catch up. We're going to recognize those years of past service as if the plan had been in existence, and we're going to cost it out. And a portion of that cost will come from the corporation. So when the corporation writes a check to the pension plan, it claims a tax deduction. So that's deduction number 1.
So that's not, but the individual doesn't get the deduction. The company gets a deduction. The individual just gets cash.
Just benefits from having a bigger pension in retirement.
Right. Okay. Keep going. That was 1.
Yeah, that's 1. Number 2, so we might blow through our 20 minutes. Number 2 is the annual contribution that's in excess of the RSP limit. So this year, the RSP gives you up to $29,000 and change of contribution room. With the PPP, especially if you're over the age of 40, you're going to be able to add more to that limit. You're going to be exceeding that limit. In fact, by the time you hit 64, you're about $18,000 more than the RSP maximum. You're at $42,000 of contributions instead of the $29,000.
Wow.
That's just on an annual basis. So year after year, you keep plowing even more money into this pot and therefore claim larger deductions because you're doing that. So that's what I call the annual advantage. Then we have another advantage called, that's number two. Number three is what's called special payment. So here's the concept. These pension plans are supposed to pay you a set retirement amount. Like if imagine you're working for the government or you're a teacher and you hit 65 and they say, okay, you're entitled to $100,000 a year for the rest of your life. That's the promised benefit. But in order to ensure that there's enough money to pay that benefit, the money has to be invested inside the pension plan. And if the people that manage the money screw up, or if the markets tank like we had with COVID and things like that, there might be a deficit, there might be a loss inside the pension fund. The law says if there's a loss, the corporation which you own, which is your own money anyway, the corporation can write an extra check, and we call that a special payment, and that's also tax deductible. And that's used to backfill the pension fund because it wasn't growing fast enough. So it ensures that you're on track to receive your promised benefit.
Wow.
So that's, yeah, I know. Can't do that with an RSP.
No.
If you lose money in an RSP, the only thing you can do is pray that it's going to recover. With us, you don't pray. You write a check and you write that off so you don't have to pay the tax. So that's the special payment, number three. Number four is what I call the RSP double dip. So in the year that you set up your pension plan, obviously you're going to get your annual deduction for contributing to the pension plan. And that annual contribution is based on your current year salary. It's a percentage of your salary. But the RRSP is also available to you because the RRSP contribution this year is based on last year's earned income. So in the current year, you can do a double contribution, double the tax relief, and put more money to work.
But is that only in the first year that you make the contributions?
Well, there's another one. It's much smaller, but in the first year, you can get either a full or a partial tax deduction for your RRSP. So that's number four. Number five is for subsequent years, to answer your question, is you're allowed a tiny $600 per year extra contribution to your RRSP, which in pension jargon, we call that the PA offset amount. So it's a little $600. It used to be $1,000 in the 90s, and then they changed it to $600. So it's a little extra.
Those cheap government guys.
So that was number five. Number six is the fact that unlike an RRSP, where you're not allowed to write off the investment management fees, right? When you're paying someone to look after your RRSPs, those fees come off the top and you can't write them off. With us, you can. So the investment management fees are completely tax deductible to the business.
But you can write them off outside the plan, like on your personal account.
No, not personal, your corporate account.
On your corporate. Got it. Sorry, I keep thinking personal. Right.
No. This is a corporate solution, but you own the corporation, so it's really your money anyway.
Right.
Deduction number 7 is the fact that if you borrow money, let's say from a line of credit or from a holdco or some other entity, in order to make contributions to the plan, the interest is also tax deductible. So you can leverage these plans, which you can't do with an RSP. You can't do that with a TFSA. You're not allowed to write off the interest.
So I could borrow a whole whack of dough and then make a back payment, going back to rule number 1, if you will, or deduction number 1, plus all the years. Wow, a lot of benefits. Okay, number 8.
Number 8 is the mother of all tax deductions. It's called terminal funding. Terminal funding, and the largest terminal funding tax deduction I've seen in my career was $2.1 million. Okay, so terminal funding is when you decide to turn on the pension before the normal retirement age. So let's go back to our teacher example of collecting $100,000 a year for the rest of your life, starting at 65. Well, if that individual said, I don't want to wait till 65, I'm sick of kids, I want to retire at 55. I want to go back to school to teach. Well, you could retire at 55, but not at 100,000. The Teachers Pension Plan Board, the administrators of the plan will say, you know what, we're going to have to reduce your pension. We're going to penalize you because for every month you're taking advantage of this. So you end up maybe, I don't know, with $40,000 a year for the rest of your life.
Yeah.
So substantial dip in your standard of living just because you wanted to start sooner. That's the normal rule. But under the PPP, by relying on the terminal funding rules, what happens is we say, okay, I want to start, let's say, at 55, at 50, at 40. There's no minimum age. And then you see there's a penalty, obviously, but we're going to add two special benefits. We're going to do a early retirement subsidy pension plus a CPP bridge pension. So these are temporary payments that are coming out of the pension plan to bridge you from the early retirement day you selected to age 65. So what we've done is we've created brand new liabilities, costs inside the pension fund for which we need money. Where does the money come from? It comes from our own corporation. So when the corporation sells stocks or whatever in order to fund this, well, you're going to get a tax deduction at the corporate level.
Okay. I kind of understand it. But it's complicated. That's probably why most people have never heard of it, because nobody wants to try to explain it.
Yeah, that's part of the problem. It's very sophisticated, but it's the cost of being able to triple or quadruple your wealth without taking any risk, right? Because all of this that I've talked about is guaranteed wealth because it's tax refunds. It's not me being better at picking stocks. In fact, if I'm really bad at picking stocks and my rate of return is low, I can do those special payments.
If this goes back, the PPP goes back in legislation 100 years, why is it only 10 years ago that they flicked the switch?
Oh, it's because it's my company that created the PPP. We're the
INTEGRIS.
one, yeah, INTEGRIS. INTEGRIS came out with a PPP, and we took the existing legislation and we repackaged it. We made it more flexible, and we branded it the PPP to distinguish it from the older model like the IPP or the RRSP. But it's all based in the same legislation.
And are you the only ones that provide it?
No, we got copied by a financial institution in the province of Quebec now. Yeah. So people
And
are
that's
starting
it.
to copy us.
Can anyone use a PPP?
Yeah. Well, anyone that's got a company that's incorporated, that's taking T for income, right? You have to have employment income because it's an employment pension plan.
Right. Okay.
So
So then let's say I get to retirement. How do I unwind it? Am I just going to take that $100,000 a year, or is it
yeah, well, you have
indexed? Or
yeah. So Pat, you have options, right? You can either take a pension, the 100,000, the 50,000, whatever it is, for as long as you live, and then if you pass away, that continues to your spouse. So that's one option. Another option is to say, I don't want to have this pension plan anymore. You can wind it up, you can terminate it, and then take the money and send them to an RRSP or a RIF, a registered retirement income fund. Or
just the same way you would do it with an RSP. You wind down an RSP and you throw it into a registered retirement income fund.
yeah, that's right. Or you could purchase an annuity from a life insurance company, and then the annuity provider, the life insurance company, is on the hook for paying you your payment, your pension. And then you don't even invest the money anymore because it's the professional money managers from the insurance company that are looking after growing the monies inside the contract. It's their responsibility. So there are all these
Okay.
options.
So then the ultimate question is, why don't more people know about this?
Good question. Part of it is that, as you pointed out at the very beginning, this is very sophisticated and complicated, and it's not being taught. It's not taught to the accountants. The financial advisors don't learn about it. So the intermediaries in the marketplace that should be talking to clients about it don't even know themselves. It's only a tiny elite in Canada that actually knows about these rules and are making it available to their clients. So that's part of the problem. The other thing is the large financial institutions that could spend money and go on an ad campaign and really blitz the market and say, hey, you guys should upgrade from your RRSP to a PPP. those financial institutions have no vested interest in doing so because they're already making money on your RRSP dollars.
Mm.
So why kill themselves to cannibalize their own book of business, right?
Right.
Not like it's so there's no incentive, unfortunately, in the industry.
So it's not generally used, number one. There's a degree of education, number two. Despite all these benefits, they're complicated.
They're complicated to explain, but once you're in one, I mean, you make your contribution, it gets invested by your trusted money manager, which is not us. We don't touch the money. And then the pot just grows faster because there's more money. If I can put 3 to 4 times more money than you, and we're both earning the same rate of return, I'm going to retire sooner. I'm going to have a lot more money than you. I mean, that's just basic math.
Yeah, you know, it's interesting. Somebody once asked me what my most expensive expense was in my lifetime. And immediately I said my mortgage. And they said, no, you're wrong. It's because of time. It's your taxes, 40 or 50 or 30% every year that you work adds up to more than your mortgage. It was an interesting perspective. So what you're looking at is exactly that. Reduce your taxes. Don't avoid taxes, but reduce the amount of taxes you pay and get all the benefits.
We're all about complaining. No, well, one secret that I have to share with your audience is that if you have an RRSP, and heaven forbid, but let's say you got $3 million, you've been really good, you've been saving, and then you grew your pot to $3 million, and you go for a drive with your spouse on the country road, and bang, you both get killed by a Mack truck.
Thanks, JP. You're really painting a nice picture.
But that's a reality. What happens? There's no rollover to a spouse, you're both dead. So that $3 million is now subjected to what's called a deemed disposition. The government deems that you sold everything in your RRSP at fair market value the day before you died. And now your estate is left with a $1.5 million tax bill. So you thought you had 3 million, you only have 1.5 million. So it's not just the tax you paid along your life, like you were talking about. It's the deemed disposition on death. So that's what happens in an RRSP or a RIF, or if you keep the money in the shares of your company. A lot of people don't use RRSPs or PPPs. They just keep it in their company. They think, oh, well, it's, low tax. Well, something else is going to be knocking on their door. It's called the tax man. So what happens if you do this in a PPP? And let's imagine that you have children that are working in your family business. So they're on the payroll as well. So they're eligible to join your plan. Same thing happens. You go on the country road with your spouse, bang, get hit by the Mack truck, you both die. Nothing happens. The full 3 million becomes pension surplus. It's surplus because there's no one to pay a pension to. There are no survivors. So the full 3 million stays inside the plan. And because your children are also members of the plan, that surplus is now theirs.
Wow.
So you just saved your family $1.5 million in taxes.
Wow.
Well, you tell me which of the two products is better.
It's too hard to explain, as you pointed out from the very beginning in 20 minutes. But JP, where can people go for more information? Well,
the best place is to go to INTEGRIS Pension Management Corp, to our website, integris-mgt.com. That's really because we have videos, we have memos, legal memos, we have PowerPoint slides, FAQs, articles. Even when I was on BNN, I was explaining what a PPP is to one of the finance journalists. So, we try to do multimodal, different people learn different ways. We have calculators you can play around with. If you want to really, really learn about this, you can take a course from the INTEGRIS University that's offered through the Knowledge Bureau. So there are courses you can take online. There's lots and lots. There's no shortage of information. The problem is awareness. People have no clue that this stuff exists, and therefore they keep paying tax because they don't know any better.
Yeah. JP, we could go on forever, but thank you so much for your time.
I'm glad to be here. Thanks a lot.
Jean-Pierre Laporte is the consultant and CEO of INTEGRIS Pension Management.